Welcome to the Deep Dive. Today we're digging into something pretty fascinating. Can the stock market, all that up and down, actually tell us something useful about corporate bonds?
It's a great question. We're looking at this paper, Cross-Asset Trends Spillover, which proposes just that.
Right. So the mission for this deep dive is basically, can stock market trends give us a heads up on where corporate bond prices might be going?
Exactly. The paper introduces a specific strategy they call X-trend.
X-trend.
Yeah. The whole point is to pull together technical signals from stocks, price movements, volume, that kind of thing, to predict bond returns.
Which is interesting because normally for bonds, you're thinking credit risk, interest rates.
Precisely. Traditional bond analysis. But this research argues that, stock technicals have shown they can predict stock prices.
People use them all the time.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So the thinking is maybe because the stock and bond markets aren't, let's say, perfectly integrated, that stock data might hold unique clues for bonds that we're otherwise missing. You might be getting an incomplete picture if you ignore that stock side.
Okay, makes sense. So how did they actually build this X-trend factor? It sounds complex.
It was definitely data intensive. They used machine learning to sift through, a massive number of potential models, the paper says, over 3.6 quadrillion.
Whoa, okay.
Yeah, based on all sorts of technical indicators from stocks moving averages, MACD, RSI, Bollinger Bands, you name it, price and volume data.
So they threw everything at it.
Pretty much. They used this specific method, a cross-sectional combined elastic net.
Right.
Which basically involved running regressions for each indicator, smoothing the results over time, forecasting returns for each one, and then combining them. It took an equally weighted average of all those individual forecasts to create the final X-trend signal. The idea is that combining them helps avoid overfitting to any single indicator and makes it perform better out of sample.
Got it. So it's a smooth combined signal from lots of stock indicators. Did it work? What were the results?
They were pretty striking, actually. They tested a long-short strategy buying bonds with high X-trend scores, besting those with low scores.
Standard factor approach.
Right. And over 20 years, September 2002 to September 2022 in the U.S. market, this strategy produced an average monthly return of 0.84%.
0.84% per month.
Per month, on average.
That's really significant, just from stock signals spilling over.
That's what the data suggests. And importantly, these profits weren't explained away by existing, well-known bond pricing model. They calculated the alpha, the excess return, and it was consistently high, ranging from 0.71% to 0.97% per month, depending on the specific model used for comparison.
Okay, wow. And did this hold up over time? Or was it just a specific period?
They found it persisted over time and across different market conditions, which is encouraging.
And what about the characteristics of the bonds themselves, the ones with high X-trend scores?
That's another interesting part. You might expect higher returns to come with higher risk, but here, not necessarily. High X-trend bonds tended to have lower standard deviations, less kurtosis, meaning fewer extreme negative returns.
Less tail risk.
Smaller drawdowns, too. And they also tended to be more liquid and face less credit risk, things like narrower credit spreads, lower default probabilities.
So potentially higher returns, lower risk characteristics. It sounds almost too good to be true. What about the companies? Do the underlying stocks have specific traits?
They did look at that. Firms whose bonds scored high on X-trend tended to be, larger, more established companies. Higher institutional ownership in the stock, lower idiosyncratic stock volatility, and lower financial stress indicators, too.
So bigger, more stable firms seem to generate these stronger trend signals that spill over. Now, the big question, why? What's the theory? Why would stock trends predict bond returns?
That's the million-dollar question, isn't it? The researchers floated a few potential explanations. One is the frog in the pan hypothesis.
Frog in the pan.
Yeah, the idea is that maybe stock investors react slowly, incrementally to new information, like a frog not noticing the water heating up. This creates gradual trends in stock prices. But then once the trend is clearer, maybe bond market participants react more strongly, or perhaps with a delay, causing this spillover.
So slow burn in stocks, then a bigger reaction in bonds once the trend is obvious.
That's one possibility. Another one they explored is anchor theory.
Anchoring, like behavioral finance.
Exactly. Maybe investors anchor on past stock price highs if a stock is trading way below its peak.
People might perceive it, and by extension its bonds, as maybe undervalued.
Right. And that perception could drive momentum that carries over from the stock to the bond.
Interesting. Psychological biases linking the two markets. Any other theories?
They also mentioned firm growth options. Stocks with higher volatility often signal more growth potential, more options embedded in the company's value. This might lead to stronger momentum effects generally, which could then spill over.
Okay, so a few plausible economic and behavioral stories. What about the practical side? Can you actually use this? What are the downsides?
Definitely need to talk about that. A huge factor is trading costs.
Ah, yes. Bonds aren't like stocks. Liquidity can be an issue.
For sure. Trading corporate bonds can be expensive. Researchers did estimate these costs.
Did it wipe out the profit?
It took a significant bite. They estimated trading costs ate up about half of those gross profits we talked about, reducing that 0.84% monthly return down to about 0.43%.
Still positive, 0.43% a month net of costs is nothing to sneeze at, but a big haircut.
It is. It really underscores how crucial implementation costs are in bond markets. However, they did note something important.
What's that?
When they focused just on investment-grade bonds, which are generally more liquid and cheaper to trade, the strategy held up much better against transaction costs. And also, extending the holding period slightly, say, up to 2 months, still showed profitability after costs.
Okay, so maybe it's more viable for investment grade, or if you're not trading super frequently, it's not a day trading strategy.
Definitely not. It alleviates some concerns about high turnover killing the returns.
And how confident are we in the factor itself? Could these results be sensitive to how they set things up, data mining or something?
That's always a concern with factors. But they really went to town on robustness checks.
How so?
They tested it against, get this, over 1.3 million alternative research designs. They varied estimation windows, different forecasting algorithms, how they weighted the portfolios, different data cleaning methods. Basically, they tried to break it in every way they could think of. And X-Trend consistently showed strong performance. It wasn't just a fluke of one specific setup. It actually improved existing bond pricing models and cut down pricing errors across most of these variations.
That's incredibly thorough.
Okay. They even mentioned its Sharpe ratio was consistently better than many other well-known factors in finance.
So from an asset pricing perspective, it seems pretty solid. Does it, change how we should think about the standard models?
Well, they argue it significantly expands the mean variance frontier, the trade-off between risk and return compared to models without X-Trend.
Adds a new dimension.
Right. And including X-Trend apparently cut the unexplained returns, the alphas, of other factors in half and reduced the number of anomalies when trying to explain bond returns across the board.
So it explains things other factors don't.
It seems to capture something unique. They even did some Bayesian analysis suggesting a high probability over 50% that X-Trend is a genuine pricing factor, part of the stochastic discount factor, alongside maybe things like post-earnings announcement drift from stocks and a credit risk factor.
Okay, so the main takeaway seems pretty clear then. Looking at stock market trends, specifically bundled into this X-Trend factor, offers real, robust predictive power for corporate bonds.
That's the core finding. It's a novel factor, statistically significant, and it goes beyond just looking at credit and rates. It highlights this cross-asset linkage.
Yeah, it really makes you think, doesn't it? How might understanding these kinds of connections, these spillovers, change how you look at market analysis or even your own investment strategy?
Absolutely. And it begs the question, what other connections are out there? What other data, maybe seemingly unrelated, could hold predictive power for different assets?
Definitely food for thought. A fascinating deep dive into how stock whispers might become bond shouts. Thanks for unpacking that.
My pleasure. It's compelling research.